get a bit more detail. Mark Bayley from FIIG Securities. The question, I suppose, is when? Timeline, Mark, in terms of those rate increases. Certainly, you'd be hard-pressed to think they're going to do it at this next meeting this week.
Yeah, good morning, James. I think that's exactly right. I mean, that's certainly what the market is pricing in and telling us, with only a 12% chance that the Fed does hike later this week. 70% chance in June is the current pricing for the market, which my personal view is that is too high. And, we did have weak data on Friday, kind of quite mixed, not just the GDP, but consumer spending and also consumer confidence is also weaker than expected. On the flip side, we did have some data that was in line and slightly stronger than expected as well. But it is that mixed data front that we have seen over the last 3 or 4 weeks in the States, which I think is pushing back those expectations of Fed hikes. And as John Noonan said in the intro, I think the market is hovering between that 1 and 2 hikes for this year. I think you'll probably see June kind of fall off to maybe 50-50, and if we don't go in June, then maybe we're just looking in either September or December again in the back end of this year. The Fed also has to consider there are a couple of swing factors that, with regards to fiscal policy in terms of Trump and his corporate tax plan as well, whether he can actually get that through Congress, and also in terms of the infrastructure spending as well. So on the fiscal side in the States, they're going to have to watch that closely as well to see if that does introduce any additional demand. And if that does come through in the figures, then you will see the Fed hike probably 2 times, as many of the FOMC members are expecting and are highlighting to be the case.
So do you just look through the first quarter? I mean, I know you have many people generally look back and try and explain away. I noted people suggesting that warmer weather was a drag on dragging down heating bills, weaker auto sales as well, had an impact in terms of the weakness. But 0.7%, that's a big miss on expectations.
No, I agree. And, it's not like the weather was a surprise. I mean, this is what frustrates me about economic data. When it doesn't come in line with people's expectations or doesn't tell the story that they want, they try and explain it away, with the weather. It's not like the weather was hot and they didn't know about it. That was already baked into the weak GDP number consensus of, I think it was 1%, and you had 1.2% consensus, and that 0.7 print is soft. And I take John's point on board that historically the first quarter has been soft, and I'm certainly not expecting that to continue into the Q2 and Q3. But it is weaker than expected, and I think we have to acknowledge that. And I think you saw that in terms of the reaction in the US Treasury markets. You saw yields fall and bond prices rise. The 10-year benchmark came off 2 basis points to 2.28%, and that indicates the data was softer than expected. And I think in terms of the pricing for the June at 70%, I think that's the one that will start to drift lower if this data continues to be mixed, because I don't think the Fed will push things, and I think it will always come from a very cautious point of view.
I'm interested in your comments as well as to how the Fed views any potential fiscal stimulus. I mean, it seems from the previous meeting that they ignore us, that until something is actually concrete and impacting the data, it's not relevant.
That's right, and that commentary has been kind of repeated time and time again, that yes, they are looking at what the government is doing, but they're not factoring that into any of their economic forecasts, which is why I think if there is a change to the corporate tax plan, tax rates get cut to 15%, and you do see some kind of impact there in terms of hiring, GDP, maybe even some wage inflation coming through, and also from the infrastructure spend, which again still hasn't got through Parliament, because they need to have some kind of budget neutrality to get it permanently legislated. Otherwise, it's only a temporary measure. And if that doesn't happen, or if it does happen, that the FOMC and the Fed will have to consider that in terms of how it sets its rates, because it will probably see some stronger economic data coming through. And as Janet Yellen reminds us time and time again, the moves of the FOMC are always data dependent.
Yeah, let's switch focus to the UK and look at their GDP. In comparison, 0.7 looked pretty good. 0.3% for GDP growth in the first quarter for the UK. That is nothing to shout home about.
No, and it was weaker than expected, marginally so. But I guess the thing in the UK, and we've talked about it previously, is that the UK has actually performed incredibly well since Brexit, and maybe just now you're starting to see some of the impact on consumer spending. Some of the price rises are coming through. Obviously you had a 15% depreciation in sterling, so that leads to imported inflation. You're starting to see some price rises coming through in supermarkets, and that's impacting consumer confidence. Also, you have a general election, and the polls over the weekend, still gave Theresa May a strong lead in over Labour, kind of anywhere between 11% and 20%, so maybe slightly down from the 25% initially. And also, as well in the UK, you've still got those very tricky Brexit negotiations with the meeting on Friday in the European Union, kind of solidifying their strong message that they're going to have a very tough bargaining stance because they don't want to make it look like it's an easy option for countries to leave. So that's all going to take place. It's all going to go in the mix, and I think you're probably going to see a bit more weakness in the UK, despite what looks like a fairly strong increase in majority for the ruling Conservative government. So I think overall you're still looking at weaker data. You probably see maybe sterling come off a bit, although you have seen some short squeezes being removed from the market. Some hedge funds are reversing the short sterling trade, and that's why you've seen a bit of a fairly buoyant currency in terms of sterling, and have seen an appreciation because you have seen a bit of stronger kind of data, and also the fact that the general election should lead to a stronger government that hopefully will get a better negotiated outcome out of the EU. But it's going to be all difficult, a lot of uncertainty, and I think potentially sterling is potentially one that could see some depreciation over the next few months.
And look, these negotiations are expected to take 2 years. That seems ambitious, in my opinion. I thought it's going to take a little bit longer than that to get the clean break from the EU. So do you expect to see this kind of Brexit uncertainty continue to act as a dampener on the UK's GDP through that period?
Yeah, I think you will, and I think one of the key drivers that we've talked about before for the UK economy is the financial sector, which is based in London, and you're seeing more and more banks talking about maybe moving their headquarters to Frankfurt or even to Dublin.
Have you been to Frankfurt, Mark?
I have been to Frankfurt.
It is not a global financial centre. As much as I love people from Frankfurt and the place, it is not London.
No, I agree you don't have that cultural diversity, but who knows? Maybe if you get 50% of the people moving over from the UK, from London, over to Frankfurt, then maybe you just still start to get a bit more of a banking kind of a capital city type feel. But I completely agree with you. It's a bit more sterile. I've got good friends over there. I used to work for Dresdner Bank, so our headquarters were over there in Frankfurt. So I've been over several times, but it is completely different feel to London, and it's going to be difficult to get that calibre of people to move over to Frankfurt, which I think is why some banks, especially Barclays, I think are looking more at Dublin as well, which I guess is English speaking as well. So there's a lot of uncertainty around that, and I agree with you. I think the negotiations in 2 years, massively ambitious. I don't think they will achieve that, and I think we'll be part way through before that 2-year time horizon comes up, and then they have the option to extend if the UK agrees, and then all the other 27 nations agree as well, which, as we know in Europe, is a very difficult thing to achieve.
Yeah, indeed. Mark Bayley, great as always to talk. Thank you.
Thanks, James. Have a good day.
You too. We are off to a quick break. When we come back, we'll have some breaking news for you. The AI Group releasing its monthly manufacturing PMI, so stay with us.